So let's do some problems now. Come to this problem. Come to this problem. An entity issues 2000 convertible bonds at the beginning of their one. The bonds have a 3-year term and issued at par with a face value of 1000 per bond, giving total proceeds of 2 million. Interest is payable annually in arrears at a nominal interest of 6%. Each bond is convertible at any time up to maturity into 250 ordinary shares. The entity has the option to settle the principal amount of convertible bonds in ordinary shares or in cash. Convertible bond. When the bonds are issued, prevailing market rate for similar debt without a conversion option is 9%. At this date, market price of one ordinary share is rupees 3. Income tax is ignored. Calculate basic and diluted EPS when what? Oh, okay. When the table is not there here. When profit attributable to equity shareholders is 1 million. Ordinary shares outstanding 1.2 million, 12 lakh. Convertible bonds outstanding 1000 was it? Okay. So now how much profit would be attributable to equity shareholders? 1 million. Can you tell me how much interest will be added for computing dilutive EPS? How much interest will you add? At what rate will you take? 6% will you take or will you take 9%? Tell me 6 or 9. Which one will you take? – 9%. On what amount will you take 9%? 9% on? Okay. Before we come to Ind AS 33, first we should apply Ind AS 32. What is Ind AS 32? This is convertible bonds. Means this is hybrid instrument having debt component and equity component. You need to separate that first. Let's calculate debt component, equity component. So convertible bonds. At the time of issue, equity component. First, total proceeds. Two million, that is 20 lakh. Debt component. Principal portion 2 million into discounting factor. Coupon payment 2 lakh into percent to annuity factor at the rate of 9% for third year, 9% for 3 years. Okay. If you take more number of decimals, you get more. Anyway, let me take 4 decimals. So how much you get actually? This 2 million multiplied by 0.7722, that will give you 15,444,000, 1,20,000 divided by 0.5313, 303,756. Total comes to 15,48,120, 150. I've taken 3 decimals. I've taken 4 decimals. You can take different decimal. That's okay. Equity component. Anyway, balancing figure, but we don't use it. You can write for your reference. 1,51,844. Okay. So finance cost taken to P&L first year is on 1848 156 multiplied by 9%. 16 lakh 66 334. Basic earnings or basic EPS for year 1 is given by 1,000,000 divided by 12 lakh 0.83 per share. Diluted earnings is 1 lakh what we have, we will increase by the this profit. Again, tax they said ignore, otherwise I would have done into 1 minus t also. Divided by how many shares are issuable? Up to 250 shares. So 250 into 2000, 500,000. That is 5 lakh. So you get 0.69 per share per equity share. Ordinary share means per equity share. It's dilutive in nature, it is reported. Okay. Hope it is done. Shall we go further? Finance cost taken to P&L account. We have prepared the amortization schedule on the debt component. You charge 9%. Opening balance 18 lakh 48 156. On that 9% will go to P&L. Coupon 12 lakh goes to cash flow statement. Opening balance plus finance cost minus coupon, remaining balance comes to next closing balance, which is opening balance for next year. On that 9%, we have done so many problems no on this amortization method. Liability carried at amortized cost method. On the amount of debt component, interest is taken to P and L. So many tables we have prepared. Don't give me shocks, heart attacks on the last day. It's fine. Okay, I'll go further.